welcome to another exciting episode of Finance Footnotes. I'm your host, Brent Stransky, joined by my friend and colleague, Zach Miner. Today is June 20th. We're near the end of the first half of the year, and we're going to do something a little different than normal. We're going to talk about some of our favorite indicators. And I think, Zach, this is maybe something we can check in quarterly or maybe at least every 6 months, just to kind of take a litmus test of where things are based on our favorite indicators. What do you think? Every maybe 3 or 6 months?
Yeah, we'll check in on the gauges, see where things are looking at. I think yours are a little more shorter term in nature. Mine are probably a little longer term, so I think they pair well together.
This is great. This is a reason to watch the entire podcast. You're going to get short and longer term notes here. And I think it's just a chance to kind of, peel back the onion, go back a couple layers. What have, I guess, together, do we have like 35 years of experience or something like that?
Mm-hmm.
What have we seen out there that seems to kind of align with what happens in the marketplace? So this is going to be a really great podcast, and we'll come back to it on a regular schedule. But per usual, let us start with a little bit of optics on where we are at the moment. So this is showing you a slide here from the Wall Street Journal this morning, and it's showing the three primary American indexes: the Dow, the S&P, the Nasdaq. And 2 out of the 3 of the S&P, which is the primary index, at or near all-time highs. So here we are halfway through the year, and things have progressed nearly up 15% so far year to date on the S&P 500. But as you may have seen in the news, and Zach, please chime in here, there's a lot of leading from the top 5 or so stocks, including the top stock, which is NVIDIA. So it seems like an equal weight index, Zach, and I don't know off the top of my head, maybe up something like 5 or 6%. Does that sound about right to you?
Yeah, around that. And NVIDIA is really driving, the magnificent one at this point. It's up another 100+%, year to date.
It's really incredible. The world, as of this morning, the world's largest company. Whereas just a couple of years ago, no one had heard of it. Even a couple of months ago, most people.
Yeah, it's pretty amazing.
I think that's the point we just want to make here. There's a market leader. It's dragging all the index with it. And if you look at an index such as the Dow Jones average, that's been a lot less attractive so far this year because it doesn't hold a lot of those big tech names that have been, that Magnificent Seven that Zach just mentioned, dragging up the S&P, that they're not present in the Dow. So the Dow isn't doing as well this year. Still positive year to date. Still certainly a good year. But just that's where we are, folks, as we go forward. So anything else, Zach, on that before we charge ahead?
Yeah, and there's a huge spread between what's working and what's not. Dow's up 4-ish%, S&P 15, Nasdaq 17, 18. But between Russell 1000 growth and value, you've got 21% versus 5. The Russell 2000 small caps are actually down year to date. So it's just a big spread between what is working and what's not. Now we've talked about it plenty of times before. That could resolve in 2 different ways, right? The rest can catch up, or the leaders can retreat. Not clear yet which way that's going to go. I think I will say that our forward-looking forecasts look pretty good at the halfway point. But we'll see how the rest of the year plays out. Obviously, some big things on the horizon.
Yeah, not to mention the elections. Namely. But so that being said, it's a great segue into the next part of the conversation here, which will be just a deeper dive into some of the benchmark or some of our favorite benchmark indicators here. But I want to preface it, as always, with a little bit of background. And this is a quote from the great writer Mark Twain. And he says, "Facts are stubborn things, but statistics are pliable." And Zach, I don't know if I ever told you this story, but when I had undergrad, I had statistics class, and it was my favorite class undergrad because the professor was hilarious. And he walked in the first day of class into his class, he had a West Virginian accent class. There are lies, damn lies, and statistics. Let's get started. And I was like, wow, this is great. And that was also a Mark Twain quote. So that being said, let's take a grain of salt as we look at these statistics, right? You can make them sing if you want to, but we're going to try to be as agnostic as possible. The first one I want to share with you, and I think it's important for a couple of reasons I'll go into, is the equity put-call ratio, okay? And I have here on the slide an explanation of at a high level what this is. Puts and calls, the derivatives that you can use to take a bet or gamble on underlying assets such as a stock price. A put is if you're looking for some type of protection, and you buy a call if you're looking for some type of leverage on the upside gain. So the put-call ratio tells us how many puts, how many protections are people buying, and this is individuals and institutional investors such as hedge funds or asset managers for pensions, versus how many people are buying call ratios. They want upside leverage. So that's that's just a bit of a nutshell. Zach, anything to add there to the put call? Just try to keep it at a very high level.
Yeah, exactly what it is.
Okay, cool. So I have a few slides here, and please bear with me, folks. It looks a little more complicated than it is, but I have 3 years starting. So this graph we're looking at here is the 12 months ending June of 2024. So this came from Barron's newspaper last week, and you're seeing a red line and a green line. The red line is the S&P 500 index, and the green line is the put call ratio. So I just go back 3 years here. And I'm going to step through, what has this indicator shown us? So as we're looking at that green line, you're seeing a trough there. That's my arrow number 1. And you're seeing kind of a peak, and that's my arrow number 2. Okay, so what that's telling you is that arrow number 1, you're getting kind of a cyclical low regarding where we are in terms of the number of protections that people are seeking. And you can see that as of November of last year, that was towards a 12-month high. People seeking much more protections per every person trying to get some type of upside leverage on a call. So the higher the number, the more fearful people are. That's typically a good time to invest. So the first indicator I have here, that was in August of 2023, more or less. S&P was down. You can see people are seeking low protection at that time. So people are feeling very optimistic at that time. Typically, that's a sign that things might be a little choppy or heady, if you will. And you can see that in August, going for those last 3 months, and Zach, you remember this, and folks at home, you probably do too. September, October, November, 3 months down in a row, down a total of 8.4% over the next 3 months. So that was an indicator that worked out. Okay, there was a trough in the marketplace, and the next 3 months are pretty negative. So if you go to November, just November of 2023, you can see there that the S&P was up about 30% over the next 12 months. So listen, this indicator doesn't always work. You can make statistics sing, but these are showing you that at that peak, which was in November of 2023, it was pretty good time to get invested. Okay, the reason I highlight this, if you look towards the very right-hand side of this chart, we're at very low rates here. Very few people seeking protection. Typically, that's a sign for pause. That's a sign for Zach and I to tell our clients, maybe it's not the most optimal time to put new money to work. It's just an idea, not that it's the end all be all. What do you think, Zach?
Yeah, I mean, the extremes do tend to, have a fairly decent short-term indication of direction of market. It doesn't necessarily have to be down. It does sometimes just trend sideways for a while. It can indicate, a trending kind of a range-bound market as well, while that kind of indicator recycles.
That's exactly right. Let me
yeah.
to your point. Let me just step through to the next 2 years. So so to your point, it's not always a perfect indicator. Nothing ever is, of course. But so here we have the next slide, the 12 months ending in June 2023. So this is exactly a year ago chart. And you can see that the first arrow I have there, September 2022, the S&P 500 was about 9%, down about 9% plus over the next month. Okay, in that September. So you can see that indicator was possibly accurate, suggesting there was going to be some chop coming. Then if you fast forward to November of 2022, that's arrow number 2. You can see that going forward for the next 12 months, of course, S&P was up about 26% in 2023. So, that was a very high level of protection. Even if you go back to the previous chart, about 200 people seeking protection for every one person seeking some upside leverage. So that was extreme pessimism. Even going back to the previous chart, the peak was at 134.
I was just going to say, I was going to say it's important to look at the scale of that chart because you just look at the peaks. If you don't look at the y-axis, 134. But then that peak on the next slide was 215. So
this is frustrating. The Barron's doesn't keep it the same.
Constant
but
scale.
We'll just have to watch it. And so to your point earlier, number 3 here, you can see that there was a kind of a peak in optimism. Fewer people buying puts. That's number 3. That was in March of last year. It was a false positive. It wasn't the right time to sell at that time based on the optimism in the marketplace. 2023 and so far in 2024 have proven to be awesome. And then going forward to 2022, the 12 months ending, kind of a similar story. I think it's interesting if you look towards the trough, which was in December of 2021. Yeah, it turned out to be a correct indicator. The market was down 18% in the whole of 2022. And then if you look towards the peak, which was closer to like maybe around 200 puts to call in, looks like a June or May or June of 2022. Market was negative 5% over the next 6 months. So not always a terrific indicator, but something I'm watching. These are smart people. This is traditionally institutional money. Why there's so many more people buying puts, Zach, chime in, but I think it's because if you're trying to manage a large pension fund or a large endowment fund or a large insurance portfolio, you're a reinsurer, for example, you need to find protection for your portfolio. And then that's one reason why there's so many more puts per calls. Is that your read as well, Zach?
Yeah, and it's two things with this indicator. The first is that it's just a very noisy indicator, right? I mean, it bounces around quite a lot. These options are generally no more than a couple months out, and so they expire, and then the ratio can flip quite quickly. So you do get a lot of these kind of peaks and valleys. I think if you saw on that prior slide, it went from 215 to 75 in less than 30 days, right? So I mean, it's a big change in this indicator. Kind of can be quite difficult to time it correctly for any sort of market decision. And then the second reason that thing that you mentioned is that a lot of it is institutional in nature, and you don't necessarily know why institutions are doing the things that they're doing. They're not necessarily making a bet on something happening. They could just be protecting a portfolio they already have. They could be hedging other risk exposures. There's interplaying reasons why protection or or upside leverage is being taken. So not always, a clear sense of like, hey, why this is the way it is, but at the extremes, it does. And I would love to know the kind of percentage, hit rate above and below certain numbers. Maybe that's a research project we'll work on at some
That's
point.
a great lead into my next indicator, my friend. Just sit tight. I'm going to show you something very exciting. But you're exactly right. Like lies, damn lies, and statistics. The only point I want you to take away from this is for me and my clients, when I'm looking at this indicator, it just puts my ear up. If there are more than 150 puts per call, okay, maybe it's a good time to buy, maybe. And then if there are fewer than 50, let's say, there's not enough fear in the marketplace. It's reason for pause. Okay, so it's just a flag that goes up. It's nothing more. It's not the end all be all. Okay,
playing the percentages, right? I think on either end of that, you're probably you're better than 50-50, right? Better than just random chance. It does give you
it's better than 50-50
a little tool in your toolbox. Yeah.
Exactly. So to build on to that, I wanted to share my second favorite indicator, and maybe this is my favorite. This is I've talked about this for years.
Yeah.
I watched it for years and years in the in Barron's, and then noticed it started to have predictive qualities to it in some instances. But this is the Citigroup Market Panic Euphoria Index, and it's published in Barron's almost every week. It's proprietary, so it's a black box. You don't exactly know what's in there, but it does have predictive qualities. So historically, I'm not sure what the time frame is. This is the statistics, right? Historically, panic readings above a certain level, indicated as panic, suggest that there's a 95% likelihood that stocks will be higher in the next 12 months. And if there is a euphoria, people are very enthusiastic about the market, and I'll show you what that means in a moment, 80% chance stocks are lower in the next year. So that's really great. That's a really great indicator. Let's step forward to see where we are here. This is taken out of Barron's this weekend. This is the 12 months, again, ending in June of 2024. So we're getting a read here. And I've got a green arrow here showing in this chart. The blue indicates that we're at a euphoria stage, okay? And that would suggest that and this is statistical anomalies. Like I think it's intriguing because the markets are generally higher, something like 75% of years, 77% of years. Is that about right?
Yeah, 3/4.
So about 3/4 of the year, you'd expect to see rolling 12-month average to be higher in the stock market. But to show an indicator that is right 80% of the time, it's a much smaller target. So only a quarter of the years are down, right? So it's a much smaller target to aim at. So if something is showing you with 80% accuracy at a 25% target, well, that's something we should be paying attention to. And this indicator has been in the euphoria setting for some time. Okay, just again, putting our ear up here. How has it worked in the last couple of years? I just wanted to show a quick sign here. This is the next chart is the 12 months ending in June 2023. So 1 year ago. So between 12 and 24 months ago. And you can see, interestingly enough, it wasn't a panic stage. And I don't really remember why that was the case, but there was a lot of panic in the marketplace according to this indicator. And that's the green arrow I'm showing you. That green line, you can't really see it there, but I added that. Anything below the green line is indicative of positive returns. And yeah, sure enough, 2023 turned to be a great year. The market was up significantly over those next 12 months, June to June, up about 30%. Is that right? Maybe more like 16%. over that period, but significant returns. So it's not always at or above, or below this threshold. It's usually kind of bouncing around the middle. It's only when it's at a stage of panic or euphoria that this index gets triggered. So coming back even 1 year further, June 22 and 12 months preceding, you can see that there was a panic indication here in November, December of this is 2021, and of course the following 12 months, which was 2022, the year of 2022, the S&P 500 was down 18%. So those are a couple of examples where this indicator seems to hold true to its promise to deliver, accuracy within 95% of the upside and then 80% on the downside. But with a grain of salt, because statistics sometimes lie. This is the chart going back even 1 year further, and this is the last one, folks. So thank you for paying attention. I'm sorry to do this to you, but I just wanted to go one level deeper on these charts, and I won't do it next time, I promise. But I want to take a look here and just show that if we go to the index in June 2021 and the 12 months prior, we can see that this index was actually at a euphoric state for some time. Now, I would argue that, first of all, it was euphoria for some time, but it didn't actually translate to bad stock market returns. So this is one of those few instances where it wasn't accurate. But this was a very strange market. If you remember, there was a lot of stimulus coming in the marketplace because of COVID. I think people were uncharacteristically optimistic because of that money hitting their checking accounts. And I think that may have led to distortion in the reading. But that being said, gosh, that's a good indicator for the coming 12 months, I think, in general.
Yeah.
So it's one of my favorites. Zach, sorry to talk without taking a breath, but yeah, those are my two indicators, and I think they're just good. They're good indicators in terms of all the data you're gathering. We read a lot of things in the news. I think these are good aggregators. So any thoughts on that one?
No, that's all good stuff. And the only thing with with you trying to time, I like the panic euphoria indicator a little bit more on the panic side, just because we tend to have V bottom recoveries in the markets. And I think that those are good indicators for kind of snapback rallies. On the euphoria side, bull markets tend to run, they tend to persist, and they tend to have really strong performance. And so, as in the case of 2021, if you had made some allocation decision when that happened and got out of the market, well, now you're 30% behind, and by the time it actually works out for you the following year, what do you do at that point? So I think
so many contributing variables, it's hard to put a pin on
many
it.
contributing variables for it, but it certainly is a characteristic or something a statistic that we look at when determining how much cash to raise for a retiree, and should we perhaps raise a little extra so that we have the next 12 months worth of distributions ready, right? So that you don't necessarily care.
Is it a good time to rebalance the portfolio? We've been running equities,
right.
Bonds have gone the other way for the last 3 years. It's a good opportunity to take a look with your financial advisor, who you know and love and trust. Take a chance to rebalance, take some chips off the table, rebalance them to the assets that are underperforming, and that's typically a good, if nothing else. So those are the 2 points I want to make to you. I know it's a bit laborious here, a little bit more statistical jargon than normal, but hopefully you walked away with some value. Let me turn it over to you, Zach, my friend. What do you have for us today?
Yeah, I'm going to so those were kind of short-term, kind of market-oriented indicators, things that we're looking at, over the next year, right, over the next 12 months. I'm going to look a little bit more at the indicators of economic health that I like to look at. And this isn't necessarily predicting anything over the next 12 months, right? It's more predicting what is the state of the economy. Are we primed for a crisis, or are we primed for a continuation of economic bull markets? And so this first one is just a list of different things that we look at, and there's 20 different ones, but I think that these are really good indicators because they compare well with a 2007 situation where everything seemed like it was quite well, but looking under the hood of the consumer and corporate balance sheets, things were not quite that good. So consumer debt to GDP, in 2007, over 100%. Today, as the end of 2023, 73%. Consumer debt to disposable personal income, that's kind of what really matters. How much debt to disposable income do you have? Can you meet your debt payments? Right now we're at 100%, right? Not fantastic, but in 2007 it was 140%, right? More debt than disposable income available to you, just not a sustainable characteristic. Mortgage debt to disposable income. How much are your housing payments taking up of your disposable income? 2007, 100%. Today, down to 60. And you kind of go down the list there. The final two are, banking system health. How much tier one capital, essentially, of readily available
And if we
capital
could take
do the
a quick pause, this is great,
yeah
and I think I would have got every one of these wrong if you asked me a quiz. I think if we go back 6 or 9 months ago, I had a bank that failed and needed to be recovered. So actually, this week that transpired, and needed to get a debit card, etc. Everything was safe and secure, but they were trying to impose a little panic into the system. Hey, is there a return to the banking troubles that we had down the road? I mean, these last two indicators, I think, really speak to the strength that the Federal Reserve has required banks, especially large institutions. You can see that last one. That's just it's 80 times more reserves than they had
yeah
just 15 years ago. It's 80 times. It's incredible. So the banking
massively
system,
stronger. It's
much stronger.
significantly stronger across the board from the financial system. And so, if you're looking for indicators of overall economic health, how are we doing from a consumer perspective, but also just a financial system perspective, much better than we were prior to that last major crisis. That doesn't necessarily mean that a bear market can't happen, right? It doesn't necessarily mean that we can't have some sort of, downturn or recession, right? This doesn't tell you anything about that, but it does tell you you can check in on these, year by year. And if you say, oh, well, hey, mortgage debt to DPI jumped from 60 to 85, 60 to 95, right? And you can look at that and say, well, now we're kind of primed for something bad happening, and then it cascades into something worse. So I like to look at this stuff. These are longer term indicators. This doesn't tell you anything about the next 12 months, but it does just tell you about the overall general health of the economy and financial system.
It does, if I can just quickly add it to before you go to the next chart, it does give us some kind of leg to stand on when you see these things in the news or they come up in your social media, crisis coming, housing crisis coming, you know, this is a leg to stand on. This is a foundation. Well, maybe, but like we're in a much sounder financial system than we were the
Yeah.
last time it happened when no one was predicting a financial crisis.
Yeah, the next one here, and this is one of many. I could have put 10 different ones in here of corporate health. How are corporations handling their debt burdens? How are they handling their cash flows? And I like looking at this one because it just kind of tells you how exposed corporations are to interest payments. And the smart CFOs in the S&P 500 did a lot of really good work in 2022 and 2021 when rates were essentially zero, and refinanced a lot of debt. And if you can see that they're as percent of before tax profits of their interest payments, how much they're paying interest on their debt is at historic lows. So they have really financed their operations, through their debt side of the ledger, very effectively. And so even though, you see, oh, hey, rates are 5.5%, it's not really if anything, it's helping these corporations, these large corporations, because they're earning interest at that rate on their cash, and they're spending interest on their debt obligations at a lower rate. So they're actually making money on the spread there. Not necessarily the same for smaller companies who don't have as sophisticated financial, CFO offices and teams of people that can extend that debt and the credit rating in order to do so. So for smaller companies, the higher rates definitely have more of an impact. But for the large corporations, and I think in the context that we're talking about when it comes to S&P 500, investing in most of our clients have significant portions of their equity holdings in large companies. Smaller proportions in small companies. They're very healthy, relative to periods in the past when it comes to this particular metric. But there's 20 different ones that we can put on the screen that would show a similar thing.
Yeah, awesome. It's a great indicator.
Yeah. And then moving on to one that we're all fairly familiar with, but I still like to look at it, and that's just valuations. And this is just the forward price to earnings ratio. So how much are you paying for every dollar of earnings, in the S&P 500? And, if you look at this first chart, you say, hey, we're a standard deviation above the 20-year average or the 30-year average, right? I mean, it's high, right? It's highly valued. Doesn't necessarily tell you much about the next 12 months. On the following chart, the left-hand side is the scatter plot of what, based on where your starting valuation is, what's your return over the next 12 months. Doesn't really tell you all that much. There's plenty of of dots that are positive with high valuations, because bull markets tend to run, right? They tend to persist, but eventually it does revert back to the mean at some point. And so on the right hand side, you can see that over the subsequent 5-year returns, it does actually tell you something. And so I think that this is a really important indicator for us as planners when we're going in to do a financial plan and we're saying we're going to project retirement income, or we're going to project allocations, and we're going to project all these things out. We have to put in assumptions into the models that spit out the results. And I think that when you are doing multi-year, what's the word I'm looking for? Projections, multi-year projections. Putting this into the model and saying, okay, hey, with 20.5 PE, what should be my return assumption? And maybe it's not 8 to 10%, right? Maybe it's 5 to 7.
Well,
Maybe it's a
this
little lower.
We've talked about this before, and I think the counter narrative could be something like, hey, the index has changed substantially over the last 30 years. We've kind of gone from
100%.
the industrial lower profitable, and we just talked about it at the onset of the podcast, to other companies that are tech driven that have much higher profit margins, much higher earnings multiples. And so some wrongly or rightly might suggest that there's been a permanent shift. It's always dangerous to say those words, but do you think that plays in at all? I mean, it's like the next natural question, I think.
Yeah, it certainly does. And just like, any other indicator, right? It changes over the time as the market and economy changes, the nature of the market and economy changes over time. So you do always have to just take that into account. But I think that just on that regression analysis on the 5-year side, it's pretty tight, right? I mean, it does tell you something about forward 5-year returns. And with where we are, essentially zero, right? Essentially 0 5-year forward returns. I think that does just raise that flag and requires you to input it into your calculus. I think we wouldn't be doing a good service to our clients if we just took the long run average of the market. Let's say you're retiring tomorrow and we're having this discussion about what your income over the next 10 years is going to be. And we're just going to put in 9%. I'm like, okay, hey, that's what it's been, right? And you spit that out in a financial plan, and here's your income, and this is what you should be able to expect. I think that going into some nuance and perhaps even showing both, and I've done that in the past too, and saying, hey, here's the long run 9% average market, but based off of where we are in the market, based off of this indicator, this is what it looks like if it's 5%. Right.
It's such a great chart. It comes from the JP Morgan Guide to the Market. They update it daily. You can get it at home, but it's something that I've viewed in the meetings many, many times. And I think it just, in a very quick chart, just shows you where we are. And I think you just make a great point. It's you're working with Brent or Zach or whomever to try to get an eye, to try to get a beat on what's going to look like in the next 3 to 5 to 10 years. And this is a really great observation, maybe to ratchet back down expectations a little bit.
Yeah. And it just gives you something to look at from a conservative perspective to say, hey, this could be what it looks like. We hope it's not. We hope that we get that long run average over 10 years, but we want to be able to prepare clients for a potentially more conservative scenario. And moving on, the best indicator there is earnings, right? And corporate earnings is the ultimate indicator. How are companies doing? How much money are they earning? Are they growing? And ultimately, the fundamentals do shine through. At some point, there are plenty of short-term dislocations and gyrations that have nothing to do with fundamentals. But I think that the dynamism of corporate America and the fact that companies have continued to grow year over year, decade over decade, is really the driving force behind S&P 500 at 5,500, hovering near that level today. And so I'm always just looking at earnings, but also earnings expectations. And you kind of have to take those two things to kind of marry them together, because a lot of what the market will do, the market is a forward-looking mechanism. It prices in things in the future. And then it confirms or rejects the reality of those expectations. And that's how you get price discovery. And so this first chart here, we're looking at the sources of earning growth, and then also profit margins on the right-hand side. I will say profit margins, keeping an eye on that. It can be noisy. It certainly drops a lot in recessionary times, but we are near or at the the quarterly highest quarterly profit margins, 12-13%.
Zach, if you asked the average person on the street, like the old David Letterman days, if you asked the person on the street what they thought the average profit margin was for the average S&P 500 company, what do you think they would say? I don't think it's anywhere near 12%.
Yeah, I mean, that's a good question. I think people could guess high. They might say 30%. I just think people
Yeah,
don't necessarily understand it. They don't necessarily know
agreed. But
where that is. But going back to your prior point about the usefulness of the PE ratio, looking back at the '01 to '07 period, which was a bull market, you were hovering in 7, 8, 9% net profit margins, even through the 2010s, 9, 10%. So we are, companies have been able to expand their net profit margins year over year, and we are at a point now up above double digits. And so that could change that characteristic. No, should we be paying more for that, the wider net margin, right? So that's another thing to take into consideration. But ultimately, it comes down to growth. And are companies growing their earnings? Are they continuing to grow? Are they making money? And we've talked about this before, but this final chart, getting down to it's almost Olympic time soon. So we're getting the high jump in corporate earnings. And we've talked about this very high bar that we have to jump over the next 3 quarters. And so we did it in this quarter, right? We got pretty much what was expected. But we've got 3 more really strong quarters that have to come. And I do believe that a lot of the performance of the year to date has been pulling forward of a lot of these expectations, and now we need to confirm them. And so if earnings do not come in, especially in Q4 2024, above 15% year over year earnings growth, well, I think that that's going to reject the narrative of that the market has been pricing in over the last 6 months with the 15+% performance. And so I'm always marrying these two things together and looking at, our expectations changing? Are they going up? Are they going down? As of right now, expectations continue to go up. We're still, these expectations are increasing, not decreasing. And that's why you're seeing that decoupling of the rate discussion. Where are the is the Fed going to cut? They're not going to cut, and the market performance, right? It used to be like, when the Fed's talking about or cutting or raising, like that's what the market's going to do. But the Fed is pushing out their cuts, right? We were supposed to be cutting already, and now they're not. But yet the market is very resilient and has not reacted negatively to pushing out those cuts because of this right here, because of the earnings have held up, because the expectations are still high. But that's a high jump. I mean, you got to jump over a big bar there at the end of the year in order to, manifest those expectations.
Contingent on consumer expectations, which have been soft lately. So maybe in the next time we get together, we can kind of address that. But yeah, corporate America looks great at the moment. Earnings look great, and we'll have to wait and see what happens. Taken together, these are some of the benchmarks that Zach and I use when we meet with clients to try to get a gauge on where things are going in the future. Nothing's perfect, as our friend Mark Twain said in the very beginning. But that being the case, it helps give us some optics on what things could be going forward. Anything else, Zach, before we sign off?
No, that's good. Some good stuff here.
You're welcome. My friends at home, hopefully you enjoyed the content here. If you have any questions, as always, please let us know. And we'll see you next time on Finance Footnotes.